Every day, people open their phones and see market prices moving. Up feels exciting. Down feels scary. News shouts urgency. Experts argue loudly. It feels like success belongs to the fastest thinker and the smartest trader. But when you look closely at big market winners, a strange truth appears. They are calm when others panic. They are patient when others rush. They do less when others do more. This book is not about secrets hidden from you. It is about simple rules ignored by many. Rules that reward discipline over drama. Rules that reward patience over prediction. The market does not reward activity. It rewards consistency. It rewards time. It rewards clear thinking. Winners understand one thing early. Wealth is not built quickly. It is built steadily. It grows when you stop fighting time and start working with it. To understand these rules, we must begin with the most powerful advantage of all: the ability to think beyond today, beyond tomorrow, beyond short-term noise. That journey starts with long-term thinking. Chapter 1. Think long-term. Long-term thinking is the foundation of every big market winner. It is the first rule because all other rules depend on it. Without long-term thinking, every decision becomes emotional. Without long-term thinking, every market move feels personal. Most people live inside the moment. They react to price movements. They react to news. They react to opinions. This reaction creates stress. Stress creates mistakes. Big winners step back. They zoom out. They see the market as a long journey, not a daily contest. They understand that markets move up and down, but wealth moves forward over time. Warren Buffett said, "Someone is sitting in the shade today because someone planted a tree long ago." This is the heart of long-term thinking. You act today for results far in the future. Short-term thinking asks, what will happen next? Long-term thinking asks, what will matter years from now? This single shift changes everything. When you think long-term, fear loses power. Daily price drops feel smaller. Temporary losses feel normal. You stop checking prices constantly. You stop needing instant results. Big winners accept volatility. They expect uncertainty. They welcome temporary discomfort. They know that progress is never a straight line. Charlie Munger said, "The first rule of compounding is to never interrupt it unnecessarily." Interrupting usually happens when people think short-term. They sell too early. They panic too fast. They chase what just went up. Long-term thinkers do the opposite. They hold when it feels boring. They stay invested when it feels uncomfortable. They wait when others rush. Time is the greatest ally in wealth creation. Time allows good decisions to mature. Time allows businesses to grow. Time smooths mistakes. Peter Lynch said, "The real key to making money in stocks is not to get scared out of them. Fear comes from short-term focus. Confidence comes from long-term vision. Long-term thinking also brings clarity. You begin to care about fundamentals. You care about business strength. You care about durability. You care about consistency. You stop asking, what is popular today? You start asking, what will still matter years from now? This mindset reduces noise. Headlines lose importance. Predictions lose charm. Daily opinions lose value. Markets are full of distractions. Long-term thinking filters them out. Big winners know they cannot control markets. They can only control behavior. Long-term thinking keeps behavior disciplined. It turns investing from gambling into planning. It turns uncertainty into opportunity. It turns patience into a competitive advantage. Most people underestimate how powerful patience can be. They want results now. They want proof quickly. They want excitement. But wealth is quiet. Wealth grows slowly. Wealth rewards those who stay consistent when nothing seems to happen. Jack Bogle said, "Stay the course." This simple advice captures decades of wisdom. Staying the course is impossible without long-term thinking. Long-term thinking also protects mental peace. You sleep better. You worry less. You stop comparing yourself to others. You understand that success has different timelines for different people. You focus on your journey. You trust your process. This is why long-term thinking comes first. It shapes how you see risk. It shapes how you handle fear. It shapes how you respond to uncertainty. Without it, every other rule collapses under pressure. With it, every rule becomes easier to follow. Before learning what to buy, before learning when to act, before learning how to protect capital, you must learn how to think beyond the moment. Long-term thinking is not about waiting blindly. It is about waiting wisely. It is about understanding that time favors discipline. This mindset prepares you for the next rule. The rule that simplifies decisions. The rule that removes confusion. The rule that helps you focus only on what truly matters. That rule is simplicity. Chapter 2. Keep it simple. Simplicity is the quiet advantage of big market winners. It does not look impressive. It does not sound intelligent. It does not create excitement. But it works. Most people believe success comes from complexity. More indicators, more opinions, more strategies, more activity. This belief creates confusion. Confusion creates doubt. Doubt creates mistakes. Big winners move in the opposite direction. They remove what is unnecessary. They ignore what does not matter. They focus only on what truly drives results. Simple thinking creates clear decisions. Clear decisions create consistency. Consistency creates long-term success. Peter Lynch said, "Simplicity is the ultimate sophistication." This idea applies perfectly to investing. Markets already carry enough uncertainty. Adding complexity only increases risk. Simple approaches are easier to understand, easier to follow, easier to repeat. Most investors fail not because their ideas are wrong. They fail because their ideas are too complicated to stick with. They abandon plans under pressure. They forget rules during fear. Simplicity protects discipline. Big winners usually follow a small set of rules. They do not change them often. They do not chase new systems every year. They trust proven principles. They know what they own. They know why they own it. They know when they will hold. They know when they will wait. Anything unclear is avoided. Complex strategies often depend on perfect timing. Perfect timing rarely exists. Simple strategies depend on patience. Patience always exists. Warren Buffett once said, "Risk comes from not knowing what you are doing. Simplicity reduces that risk." When things are simple, mistakes are easier to spot. When things are simple, emotions are easier to control. When things are simple, decisions feel lighter. Simplicity also saves mental energy. You stop overthinking. You stop second-guessing. You stop reacting to every new idea. This mental clarity is powerful. It keeps you calm during volatility. It keeps you steady during uncertainty. Big winners understand that complexity feels smart, but behaves fragile. Simplicity feels boring, but behaves strong. Simple investing is repeatable. It works in good times. It works in bad times. It works when markets are calm. It works when markets are chaotic. Complex systems often break during stress. Simple systems bend, but survive. Another benefit of simplicity is patience. When your approach is simple, waiting becomes easier. You are not constantly adjusting. You are not constantly reacting. You let time work quietly. Jack Bogle said, "Do not look for the needle in the haystack, just buy the haystack." This mindset removes unnecessary effort. Simplicity does not mean ignorance. It means clarity. It means choosing understanding over confusion. Big winners read less noise. They listen less to predictions. They avoid endless debates. They know that more information does not always mean better decisions. Often it means more doubt. Simplicity also builds confidence. You trust your process. You trust your rules. You trust your time horizon. This confidence is not arrogance. It is quiet assurance. Markets test investors constantly. Through price swings, through headlines, through fear and greed. Simple rules act like anchors. They hold you steady when emotions rise. The goal is not to be clever. The goal is to be consistent. Albert Einstein said, "If you cannot explain it simply, you do not understand it well enough." Understanding leads to conviction. Conviction leads to patience. Simplicity also helps you stay focused on long-term goals. You stop chasing short-term excitement. You stop comparing yourself to others. You move at your own pace. Big winners know that wealth is built by doing a few things right for a long time, not by doing many things for a short time. They reduce decisions. They reduce activity. They reduce stress. Less action often leads to better outcomes. This chapter connects directly to long-term thinking. Long-term thinking gives direction. Simplicity makes the journey manageable. Without simplicity, long-term plans feel heavy. With simplicity, long-term plans feel achievable. Before learning how to control emotions, before learning how to choose quality, before learning how to protect capital, you must first remove unnecessary complexity. Simplicity is not a shortcut. It is a filter. It filters noise. It filters ego. It filters impatience. And once simplicity is in place, the next challenge appears. The challenge that ruins more investors than bad strategies ever do. The challenge of emotions. That is where the next rule begins. Chapter 3. Control emotions. Emotions decide most outcomes in the market. Not intelligence, not education, not access to information. Fear and greed sit behind almost every bad decision. Fear pushes people to sell too early. Greed pushes people to buy too late. Both destroy discipline. Big market winners understand one hard truth early. The market does not move against you. Your emotions move against you. When prices rise quickly, excitement grows. People feel smart. They feel confident. They feel unstoppable. This is when discipline disappears. Rules feel unnecessary. Risk feels invisible. When prices fall suddenly, fear takes control. Doubt replaces confidence. Patience feels painful. Long-term plans feel foolish. This emotional cycle repeats endlessly. Markets change. Human behavior does not. Benjamin Graham said, "The investor's worst enemy is himself." This is not poetry. It is a warning. Big winners do not try to eliminate emotions. They know that is impossible. They design systems that protect them from emotions. They accept fear as natural. They accept greed as human. They simply refuse to obey them. Emotional control begins with awareness. You notice what you feel before you act. You pause. You breathe. You wait. Most people act first and think later. Winners reverse this order. They know that markets reward patience, but punish urgency. Fear feels urgent. Greed feels urgent. Urgency leads to mistakes. Long-term thinkers expect discomfort. They prepare for it mentally. They do not see volatility as danger. They see it as normal. Howard Marks said, "The biggest investing errors come not from factors that are informational or analytical, but from psychological." This is why emotional control matters more than clever strategies. When emotions take over, people abandon simplicity. They chase trends. They follow crowds. They break their own rules. Big winners stay boring during exciting times. They stay calm during scary times. They do not celebrate too early. They do not panic too fast. Emotional control also means resisting comparison. Looking at others creates pressure. Pressure creates poor decisions. Someone will always make money faster. Someone will always lose money faster. Big winners focus on their own process. They measure progress by discipline, not by short-term results. They understand that outcomes fluctuate. Behavior compounds. Another emotional trap is the need to be right. Ego wants validation. Ego wants recognition. Markets punish ego quickly. Winners accept being wrong sometimes. They accept uncertainty. They accept that they cannot predict the future. This humility keeps emotions balanced. Emotional control improves decision quality. You think clearly. You see risk honestly. You avoid impulsive moves. It also improves mental peace. You stop checking prices constantly. You stop reacting to every opinion. You create distance between yourself and noise. Jack Bogle said, "Do not let the noise of others' opinions drown out your own inner voice." That inner voice grows stronger with emotional discipline. One powerful tool big winners use is rules. Rules reduce decision-making under stress. Rules guide action when emotions rise. When rules are clear, emotions lose power. Another tool is time. Time cools emotions. Time brings perspective. Most bad decisions feel urgent. Very few good decisions are. Winners wait. They delay action. They allow emotions to settle. They know that patience is not passive. It is protective. Emotional control also means accepting boredom. Markets are often dull. Nothing happens for long periods. Many people trade out of boredom. This destroys returns. Winners are comfortable doing nothing. They understand that inactivity is often the best action. This calm behavior compounds quietly. Emotions also appear after success. Success can create overconfidence. Overconfidence increases risk. Big winners stay cautious even after wins. They do not increase risk just because things worked before. They respect randomness. They respect uncertainty. Ray Dalio said, "Pain plus reflection equals progress." Reflection turns emotional experiences into wisdom. Winners learn from mistakes without emotional damage. They analyze calmly. They adjust thoughtfully. They do not punish themselves emotionally. They improve their systems instead. Emotional control is not about perfection. It is about consistency. You will feel fear. You will feel greed. You will feel doubt. What matters is what you do next. This chapter connects directly to simplicity. Simple rules are easier to follow emotionally. Complex systems collapse under stress. With emotional control, long-term thinking survives volatility. Without it, even the best strategy fails. Before learning how to choose great investments, before learning how to grow wealth, you must first learn how to protect your mind. Once emotions are under control, a new clarity appears. You begin to see what truly matters. You begin to value strength over excitement. That leads to the next rule, the rule of focusing on quality. Chapter 4. Focus on quality. Quality is what separates lasting winners from temporary winners. It is easy to chase excitement. It is hard to choose strength. Most people look for what is moving fast, what is popular, what is talked about everywhere. Big market winners look for something different. They look for durability. They look for reliability. They look for strength that lasts through time. Quality is not always loud. Quality is often quiet. Strong businesses grow slowly but steadily. They survive hard times. They adapt to change. They keep delivering value year after year. Weak businesses can look attractive for a short time. They rise fast. They fall faster. Big winners understand this difference. They prefer steady progress over dramatic spikes. Quality begins with understanding. Understanding how a business makes money. Understanding why customers stay loyal. Understanding what protects the business from competitors. If something cannot be understood simply, it is avoided. Warren Buffett said, "It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price." This idea reflects deep wisdom. Quality reduces risk. Quality increases confidence. Quality supports patience. When you own quality, temporary price drops feel less frightening. You trust the foundation. You trust the process. Big winners care about strong management, leaders who think long-term, leaders who act responsibly, leaders who protect reputation. They know that good leadership compounds value. Quality also means financial strength, healthy balance sheets, consistent earnings, sustainable growth. These things may sound boring, but boring builds wealth. Howard Marks said, "Investing is not about beating others at their game. It is about controlling yourself at your own game." Quality helps with that control. Another part of quality is resilience, how a business performs during hard times, how it responds to pressure. Markets will face crises, economies will slow, fear will return again and again. Quality survives these moments, weakness does not. Big winners prepare for bad times by choosing quality in good times. Quality investing also reduces the need for constant action. You do not need to trade often. You do not need to react constantly. You let strong foundations do the work. Quality aligns perfectly with long-term thinking. Strong businesses need time to show their power. They reward patience generously. Peter Lynch said, "Owning stocks is like owning businesses." This mindset changes everything. You stop thinking in price movements. You start thinking in business progress. This shift improves decision-making. It reduces emotional reactions. Quality also protects against mistakes. Even good investors make errors. Quality gives room for recovery. Weak investments offer no forgiveness. Big winners also understand that quality is not always cheap, but cheap is not always quality. They do not rush to buy just because something looks inexpensive. They ask why it is inexpensive. Sometimes price reflects problems. Sometimes it reflects opportunity. Quality helps you tell the difference. Another benefit of focusing on quality is sleep. Peace of mind matters. Stress destroys discipline. When you trust what you own, you worry less. You sleep better. You think clearer. Quality supports emotional control. It makes patience easier. This chapter connects deeply with the previous one. Emotional control is easier when you own quality. Fear loses strength. Quality also supports simplicity. You need fewer investments. You need fewer decisions. Big winners do not own everything. They own what they understand deeply. They avoid speculation. They avoid hype. They avoid stories without substance. They choose evidence over excitement. Quality does not guarantee success every time, but it increases the odds greatly. Investing is about probabilities, not certainty. Quality improves those probabilities. As time passes, quality reveals itself. Strong businesses grow stronger. Weak ones fade away. This natural process rewards patience and discipline. Before learning how to protect capital, before learning how to stay humble, you must learn to value strength over speed. Quality is not about perfection. It is about reliability. It is about choosing investments that can survive mistakes, survive uncertainty, survive time. When quality becomes a habit, decisions feel lighter. Stress reduces. Confidence grows. This rule prepares you for the next challenge. The challenge of waiting. The challenge of doing nothing when action feels tempting. That challenge is patience. Chapter 5. Patience is power. Patience is the quiet force behind every big market winner. It rarely gets credit. It never feels exciting. Yet it decides outcomes more than talent or intelligence. Most people believe action creates results. They feel progress only when they are busy. When nothing happens, they feel uncomfortable. Markets reward the opposite behavior. They reward waiting. They reward restraint. They reward endurance. Big winners understand that time does the heavy work. Their job is to stay out of its way. Patience begins with accepting reality. Markets move in cycles. Progress comes in waves. Long periods of nothing are normal. Many investors fail during quiet times. They mistake silence for failure. They trade out of boredom. They change plans too early. This breaks compounding. Charlie Munger said, "The big money is not in the buying or the selling, but in the waiting." Waiting sounds passive. In reality, it requires strength. Patience is active discipline. It means holding when doubt appears. It means staying calm when others rush. It means trusting a process without constant proof. Impatience creates unnecessary action. Unnecessary action creates mistakes. Big winners are comfortable being inactive. They know that doing nothing is often the best decision. Markets constantly tempt investors. New ideas appear daily. New trends promise fast results. New stories sound convincing. Patience acts like a filter. It removes distractions. It keeps focus on what truly matters. Warren Buffett said, "The stock market is designed to transfer money from the active to the patient. This happens slowly, then suddenly." Patience also protects emotions. When you are patient, fear weakens. Greed loses urgency. You stop reacting to short-term movements. You stop checking prices constantly. Time creates perspective. What felt dramatic last week feels small later. Big winners plan their patience in advance. They decide before emotions rise. They know how long they are willing to wait. This removes pressure during stress. Patience does not mean ignoring reality. It means responding thoughtfully, not emotionally. There are times to act, but most of the time, waiting is wiser. Another challenge patience solves is comparison. Looking at others creates impatience. You feel behind. You feel pressure. Big winners avoid comparison. They measure progress by behavior, not speed. Everyone has a different timeline. Forcing yours only creates damage. Patience also supports quality investing. Strong businesses need time to show results. Rushing defeats their advantage. Peter Lynch said, "The key to making money is staying invested." Staying invested requires patience. Markets often reward patience unevenly. Nothing happens for a long time. Then progress appears suddenly. Those who waited benefit. Those who rushed miss it. Patience also reduces regret. You stop chasing missed opportunities. You stop reacting emotionally to what you did not buy. You focus on what you own. Big winners understand that opportunity is endless. Missing one does not matter. What matters is staying disciplined. Patience is also a form of risk management. It prevents overtrading. It prevents emotional decisions. Less action often means fewer mistakes. Jack Bogle said, "Do not just do something, stand there." This advice feels uncomfortable, but it works. Patience requires confidence in your process. Confidence grows from simplicity and quality. These rules support each other. Patience is easier when your plan is clear. It is easier when you trust what you own. Markets test patience intentionally. They reward those who endure boredom and doubt. Impatience usually shows up before success, right before compounding begins. This is why patience feels hard. It demands faith in time. Big winners treat patience as a skill. They practice it. They protect it. They avoid environments that encourage constant action. They limit noise. Patience also brings peace of mind. You stop feeling rushed. You stop feeling pressured. You move at a steady pace. This chapter connects deeply with quality and emotional control. Quality makes waiting safer. Emotional control makes waiting possible. Without patience, long-term thinking collapses. Before learning how to build systems, before learning how to protect capital, you must master the ability to wait calmly. Patience is not slow thinking. It is strong thinking. It is the power to let time finish the work you started. With patience in place, the next rule becomes clear. The rule that turns discipline into habit. The rule of building systems, not dreams. Chapter 6. Build systems, not dreams. Dreams feel inspiring. Systems create results. Most people rely on motivation. Motivation rises. Motivation falls. When motivation disappears, action stops. Big market winners do not depend on feelings. They depend on structure. They depend on routines. They depend on repeatable behavior. A system is a set of simple rules followed consistently. It removes emotion from decisions. It reduces thinking under pressure. It creates stability when markets feel unstable. Dreams are vague. Systems are clear. Dreams say, "I want to be rich." Systems say, "This is what I do every time." Big winners design their behavior before emotions appear. They decide in calm moments. They act automatically during stressful moments. This is the power of systems. Markets are unpredictable. Your behavior should not be. When you rely on judgment alone, emotions interfere. Fear changes your mind. Greed changes your plan. Systems protect discipline. Warren Buffett said, "You do not have to be smarter than others. You have to be more disciplined than others." Discipline lives inside systems. A good system answers important questions in advance. When to invest, when to wait, when to ignore noise, when to stay calm. This clarity reduces stress. Big winners simplify decisions. They reduce choice. They reduce temptation. Fewer decisions mean fewer mistakes. Systems also create consistency. Consistency builds trust in yourself. Trust builds confidence. Confidence is not arrogance. It is knowing you will follow your rules. Another advantage of systems is protection from extremes. During excitement, systems slow you down. During fear, systems hold you steady. They act like guardrails. Many investors fail not because they lack knowledge. They fail because they lack structure. Knowledge without systems turns into chaos. Systems turn ideas into action. A simple investing system might include regular investing, clear rules for holding, clear rules for avoiding noise. Nothing fancy, nothing complex. Simplicity makes systems easier to follow. Jack Bogle said, "Successful investing is about common sense and uncommon discipline." Discipline grows inside systems. Systems also remove the need to predict. Prediction creates pressure. Pressure creates mistakes. With a system, you focus on process, not outcomes. Outcomes fluctuate. Process compounds. Big winners measure success by adherence to systems, not by short-term results. This mindset reduces emotional swings. Another benefit of systems is resilience. When markets fall, systems continue. When markets rise, systems continue. They do not react. They respond consistently. Systems also support patience. When rules are clear, waiting feels purposeful. You are not guessing. You are following a plan. This removes doubt. Systems free mental energy. You stop debating every decision. You stop second-guessing. Your mind becomes quieter. Big winners also know when to improve systems. They adjust slowly. They test thoughtfully. They avoid constant changes. Frequent changes destroy consistency. A system should be boring. Boring systems last. Exciting systems invite risk. Systems also protect against ego. You are less tempted to prove something. You are less tempted to show intelligence. You simply follow the rules. Ray Dalio said, "A good plan allows you to be wrong and still succeed." Systems are built for imperfection. They assume mistakes will happen. They are designed to survive them. This is why systems matter more than talent. Talent without structure fails under pressure. Systems turn average behavior into strong results. Another key aspect of systems is automation. Automated actions remove hesitation. They remove excuses. You do not need willpower every time. This consistency is powerful over long periods. Big winners build systems that align with long-term thinking. They are not rushed. They are not reactive. They are steady. Systems also align with simplicity. The fewer rules, the better. Complex systems collapse emotionally. Simple systems survive. A strong system fits your personality. It feels natural. It feels manageable. If a system feels stressful, it will not last. Big winners choose systems they can follow during bad days, not just good days. They test systems against fear, against boredom, against impatience. If a system survives these tests, it stays. Systems also support humility. You accept that you do not know everything. You rely on process instead of prediction. This reduces pressure to be right. Markets will surprise you. Systems help you survive surprises. This chapter connects directly to patience. Patience needs structure to survive boredom. It also connects to emotional control. Systems reduce emotional decision-making. And it connects to quality. Systems help you hold strong assets without panic. Before learning how to protect capital fully. Before learning how to stay humble during success. You must build structures that guide behavior. Dreams inspire beginnings. Systems create endings. Wealth is not built by motivation. It is built by repetition. With systems in place, a new priority becomes clear. The need to protect what you have already built. That leads to the next rule. Protect before you grow. Chapter 7. Protect before you grow. Protection is the rule most people ignore. Growth gets all the attention. Protection does the real work. Big market winners think differently. They care first about survival. They care first about staying in the game. Growth means nothing if you cannot protect what you already have. Many investors focus only on upside. They dream about gains. They imagine future success. They forget one simple truth. Big losses destroy progress faster than gains can rebuild it. Protecting capital is not fear, it is wisdom. Warren Buffett said, "Rule 1 is never lose money. Rule 2 is never forget Rule 1. This does not mean losses never happen. It means avoiding losses that cannot be recovered from. Small mistakes are normal. Big mistakes are dangerous. Big winners understand the difference. Protection begins with risk awareness. Knowing what can go wrong. Knowing how much you can lose. Knowing what you can tolerate emotionally and financially. Ignoring risk does not remove it. It only hides it. Big winners face risk honestly. They plan for bad outcomes before good ones. Markets will fall. Crises will come. Fear will return. Protection prepares you for these moments. One major protection tool is diversification. Not owning everything. Not betting on one idea. Not depending on one outcome. Diversification reduces damage. It spreads risk. It does not remove losses. It prevents destruction. Another protection tool is position sizing. Not risking too much on one decision. Not letting confidence turn into recklessness. Big winners stay cautious even when things work. Especially when things work. Success can be dangerous. It creates overconfidence. Overconfidence invites risk. Protection also means avoiding leverage. Borrowed money magnifies mistakes. Small errors become large disasters. Many fortunes are destroyed by leverage. Very few are built safely with it. Big winners choose survival over speed. Another part of protection is emotional safety. If an investment causes constant stress, it is a risk. Stress leads to bad decisions. Peace of mind matters. Quality investments help here. Strong foundations reduce worry. Systems help here. Rules prevent panic. Patience helps here. Time allows recovery. All rules work together. Big winners also keep margin for error. They leave room for mistakes. They avoid fragile setups. Fragile strategies work only in perfect conditions. Markets are rarely perfect. Robust strategies survive many conditions. Howard Marks said, "You cannot predict, you can prepare." Preparation is protection. Protection also means avoiding permanent loss. Temporary drops recover. Permanent losses do not. Understanding this difference changes behavior. Big winners accept volatility. They fear ruin. Volatility is uncomfortable. Ruin is final. Protection focuses on avoiding ruin. This mindset reduces reckless behavior. Another protection principle is humility, admitting you can be wrong. Planning for uncertainty. Arrogance removes protection. Big winners never assume certainty. They build plans that work even if they are wrong. Protection also means knowing when not to act. Not every opportunity is worth taking. Not every idea deserves attention. Saying no is protection. Most losses come from unnecessary action. Doing too much. Risking too much. Big winners do fewer things. They do them carefully. Protection also means maintaining liquidity. Having flexibility. Having options during stress. Forced decisions destroy wealth. Liquidity gives control. Another overlooked protection is health and mindset. Burnout leads to mistakes. Fatigue reduces judgment. Big winners protect their energy. They avoid constant stress. Clear thinking requires calm living. Protection is not exciting. It feels slow. It feels cautious. But it compounds quietly. When markets fall hard, protected investors survive. When markets recover, survivors benefit. This is how wealth transfers over time. Jack Bogle said, "The enemy of a good plan is the dream of a perfect plan. Chasing perfection often removes protection." Big winners accept imperfection. They design systems that survive it. Protection also builds confidence. Not the loud kind, the quiet kind. confidence that you can endure storms. This confidence allows patience to continue. It allows long-term thinking to survive fear. Without protection, discipline collapses under pressure. Before thinking about faster growth, before seeking higher returns, you must first ensure survival. Growth comes after protection, always. This chapter connects deeply with systems. Systems enforce protection automatically. It connects with emotional control. Protection reduces panic. It connects with quality. Strong foundations reduce damage. And it connects with patience. Survival allows time to work. Big market winners are not reckless. They are careful. They are prepared. They know the goal is not to win every year. The goal is to stay in the game forever. Once protection is secure, another challenge appears. The challenge of success. The challenge of ego. That leads to the next rule. Stay humble. Chapter 8. Stay humble. Humility is the invisible shield of big market winners. It protects them from ego. It protects them from overconfidence. It protects them from destruction after success. Markets reward humility and punish arrogance, often quietly, sometimes brutally. Many investors fail not after losses, but after wins. Success creates confidence. Confidence turns into certainty. Certainty turns into risk. Big market winners break this cycle early. They never assume they are special. They never believe they have mastered the market. They respect uncertainty. Humility begins with accepting one truth. The future cannot be predicted. No one knows what will happen next. This acceptance creates calm. It removes pressure to be right. Warren Buffett said, "The most important thing to do if you find yourself in a hole is to stop digging." Humility helps you stop digging. Arrogance keeps digging deeper. Big winners assume they can be wrong. They plan for it. They prepare for it. They do not build fragile strategies that require perfection. They build strong ones that survive mistakes. Humility also means listening more than talking, observing more than reacting. Markets give feedback every day. Humble investors learn from it. Arrogant investors argue with it. Big winners change their minds when facts change. They do not protect opinions. They protect capital. This flexibility is strength. John Maynard Keynes said, "When the facts change, I change my mind. What do you do?" This mindset requires humility. Another form of humility is avoiding the need to impress. Markets do not reward intelligence displays. They reward discipline. Complex strategies often come from ego. Simple strategies come from humility. Big winners do not need to look smart. They need to be consistent. Humility also protects against comparison. Comparing creates ego. Ego creates pressure. Someone will always outperform you in the short term. Chasing them leads to mistakes. Big winners stay in their lane. They trust their process. They ignore noise. Humility allows patience to continue. It allows waiting without doubt. Arrogance demands action. It demands proof. It demands recognition. Markets punish this behavior. Another danger humility protects against is prediction addiction. Predicting feels powerful. It creates the illusion of control. Big winners avoid prediction. They focus on preparation. Preparation survives uncertainty. Prediction does not. Howard Marks said, "The most important thing is knowing what you do not know." This awareness reduces risk. Humility also improves learning. You stay curious. You stay open. Arrogant minds stop learning. Humble minds evolve. Markets change. Strategies must adapt slowly. Only humble investors adapt correctly. Humility does not mean lack of confidence. It means confidence without ego. You trust your system. You trust your discipline. You do not trust forecasts. This balance is powerful. Big winners also stay humble during losses. They do not panic. They do not blame. They analyze calmly. They improve systems. Losses become lessons. Arrogance turns losses into emotional damage. Humility turns them into education. Another aspect of humility is respecting risk at all times, even after years of success. Especially after years of success. Markets do not care about your history. Big winners know this. They never increase risk just because things worked before. They never assume the future will behave the same way. This mindset protects long-term survival. Humility also improves emotional control. You stop needing validation. You stop chasing excitement. You become steady. This steadiness is rare. It is valuable. Humility connects deeply with protection. Ego removes safeguards. Humility enforces them. It connects with systems. Systems reduce ego-driven decisions. It connects with patience. Humble investors are willing to wait. And it connects with quality. They respect strength over stories. Big winners never say they cannot lose. They say they are prepared to lose small. They aim to survive first, grow second. This mindset keeps them in the game when others disappear. Humility also brings peace. You stop fighting the market. You move with it. You accept uncertainty as part of the journey. Markets are teachers. Humility is the ability to listen. Without humility, success becomes dangerous. With humility, success becomes sustainable. This chapter prepares you for the next challenge. The challenge of independence. The challenge of standing alone while crowds move together. That next rule is learning to ignore the crowd. Chapter 9. Ignore the crowd. The crowd is loud. The crowd is emotional. The crowd is always certain. And the crowd is usually wrong at the most important moments. Markets move because people react together. Fear spreads fast. Excitement spreads faster. Big market winners understand this pattern deeply. They do not fight the crowd emotionally. They simply refuse to follow it. Most people feel safety in numbers. If everyone is buying, it feels safe to buy. If everyone is selling, it feels safe to sell. This feeling is powerful and dangerous. The crowd buys near highs. The crowd sells near lows. This behavior repeats endlessly. Big winners step away when emotions rise. John Templeton said, "Bull markets are born on pessimism, grow on skepticism, mature on optimism, and die on euphoria." The crowd enters at optimism. The crowd exits at fear. Winners do the opposite. Ignoring the crowd does not mean being stubborn. It means thinking independently. It means questioning popular beliefs. Big winners ask different questions. Why is everyone excited? Why is everyone scared? What assumptions are being ignored? Crowds react to headlines. Winners look at fundamentals. Crowds chase stories. Winners analyze reality. Noise is the weapon of the crowd. It creates urgency. It creates pressure. Urgency kills patience. Markets today amplify crowd behavior. News moves instantly. Opinions spread endlessly. This constant noise makes discipline harder. Big winners protect themselves deliberately. They limit exposure to opinions. They reduce news consumption. They choose information carefully. More information does not mean better decisions. Often it means more confusion. Crowds love predictions. Predictions feel comforting. They give a false sense of control. Winners do not rely on predictions. They rely on preparation. Howard Marks said, "The most important thing is not to get caught up in the crowd." This advice becomes more valuable over time. Crowds move emotionally. Emotion clouds judgment. Big winners stay calm by design. They know that markets exaggerate in both directions. When prices rise fast, excitement hides risk. When prices fall fast, fear hides opportunity. Ignoring the crowd allows you to see clearly. Another danger of the crowd is comparison. Seeing others succeed quickly creates impatience. Impatience leads to mistakes. Big winners do not measure success by speed. They measure it by consistency. They know that different paths produce different timelines. Crowds reward short-term winners loudly. Long-term winners quietly pass them later. The crowd also loves certainty, simple answers, strong opinions. Markets do not offer certainty. They offer probabilities. Winners are comfortable with uncertainty. Crowds are not. Crowds swing from confidence to panic quickly. Winners move slowly. This difference creates opportunity. Ignoring the crowd also protects emotional control. You stop reacting to every move. You stop needing validation. You become self-directed. Big winners trust their systems. They trust their process. When systems are clear, crowd pressure weakens. Crowds change opinions constantly. Systems remain stable. This stability allows patience to survive. Another form of crowd pressure is social approval. People want to feel smart. They want agreement. Markets punish the need for approval. Big winners are comfortable being alone in their thinking. They do not need applause. They know that correct decisions often feel uncomfortable at first. Contrarian thinking does not mean opposing everything. It means thinking for yourself. Sometimes the crowd is right, but winners wait for confirmation from fundamentals. They never follow blindly. Ignoring the crowd also means avoiding hype. Hype exaggerates potential. It hides risk. Big winners are skeptical of excitement. They ask what is being ignored. They remember past cycles. They remember past stories. History teaches humility. Markets repeat human behavior. Fear and greed never change. Big winners learn from these patterns. Crowds also shorten time horizons. They focus on today, on tomorrow. Winners think years ahead. This time difference creates edge. Crowds chase trends. Winners build positions slowly. Crowds react. Winners plan. Ignoring the crowd requires confidence. Not loud confidence. Quiet confidence. Confidence built on preparation, on systems, on discipline. This chapter connects with humility. Humble investors do not assume crowds are foolish. They simply know crowds are emotional. It connects with patience. Patience allows distance from noise. It connects with simplicity. Simple plans are easier to defend against pressure. And it connects with long-term thinking. Long horizons reduce crowd influence. Big market winners do not try to change the crowd. They let it behave as it always has. They position themselves differently. Ignoring the crowd does not guarantee instant success. It often feels lonely. It often feels uncomfortable. But over time, it creates clarity. Clarity leads to better decisions. Better decisions compound quietly. As noise fades, one final force remains. The force that multiplies every good decision. The force that rewards discipline over time. That force is compounding. Chapter 10. Let compounding work. Compounding is the quiet engine behind every big market winner. It works slowly, it works silently, and then it works powerfully. Most people underestimate compounding because it feels boring. Nothing dramatic happens at first. Progress looks small. Results feel distant. This is why many quit early. Big winners understand a simple truth. Small gains repeated consistently become massive over time. Compounding does not need brilliance. It needs patience. It needs discipline. It needs time. Albert Einstein called compounding the strongest force in the universe. Not because it is fast, but because it is relentless. Compounding rewards consistency more than intensity. Doing a little, done well, for a long time. Many people want quick results. They want proof now. They want excitement. Compounding offers none of that early. In the beginning, progress feels invisible. Your effort looks the same. Your balance barely changes. This phase tests belief. Big winners push through this stage calmly. They trust the math. They trust time. They know that compounding accelerates later. Time is the key ingredient. Without time, compounding cannot work. This is why long-term thinking matters so much. Interrupting compounding is costly. Selling too early. Changing plans too often. Reacting emotionally. Charlie Munger said, "The first rule of compounding is to never interrupt it unnecessarily." Most investors interrupt it constantly. They jump from idea to idea. They chase recent winners. They abandon slow progress. This resets the process again and again. Big winners stay invested. They allow growth to stack on growth. Compounding also rewards survival. You must stay in the game. You must avoid destruction. Protection makes compounding possible. Large losses break the chain. Recovery takes time. This is why protecting capital comes before seeking higher returns. Compounding also favors simplicity. Simple systems are easier to maintain, easier to repeat. Complex strategies break under pressure. Consistency fuels compounding. Another important aspect of compounding is behavior. Good habits compound. Bad habits compound too. Small mistakes repeated grow large. Small disciplines repeated grow powerful. Big winners focus on behavior first. They show up consistently. They follow systems consistently. They allow time to magnify their actions. Compounding also reduces stress. When you trust time, you stop rushing. You stop forcing results. You let progress unfold naturally. This calm mindset supports emotional control. Markets will fluctuate. Prices will rise and fall. Compounding works through volatility. Temporary declines feel less important when your horizon is long. Jack Bogle said, "Time is your friend. Impulse is your enemy. Impulse interrupts compounding." Another mistake people make is judging compounding too early. They expect visible results quickly. Compounding is backloaded. Most of the gains arrive later. This is why patience feels hard early and easy later. Big winners understand this curve. They do not demand proof every year. They demand discipline every year. They measure progress by adherence, not excitement. Compounding also benefits from reinvestment. Letting gains stay invested. Letting growth build on growth. Taking profits too early weakens compounding. Big winners delay gratification. They choose later rewards over early pleasure. This choice separates winners from spectators. Compounding also applies beyond money. Knowledge compounds, experience compounds, judgment compounds. Each cycle teaches lessons. Over time, decision-making improves naturally. This creates a positive loop. The longer you stay disciplined, the easier discipline becomes. Compounding turns patience into confidence. This chapter ties every rule together. Long-term thinking gives time. Simplicity maintains consistency. Emotional control prevents interruption. Quality supports endurance. Patience allows waiting. Systems ensure repetition. Protection prevents destruction. Humility avoids overreach. Ignoring the crowd reduces distraction. All of these allow compounding to work. Compounding does not care about speed. It cares about survival and consistency. Big market winners do not try to accelerate it. They respect it. They know that time plus discipline creates outcomes that look magical to others. There is no shortcut to compounding, but there is a clear path. Stay invested. Stay disciplined. Stay patient. And let time finish the work you started.